Good morning, ladies and gentlemen. My name is Harold Van Hayden. I'm head of renewables at Arctic Securities, and we are very excited to introduce you again today to Alternus Energy, a renewable company that has experienced strong growth over the last period, and we have followed them closely, and we are very proud to be part of that journey and seeing their first day of trading on Euronext Growth today. So we would like to take this occasion to give you some more in-depth information about the company and also the opportunity to pose some questions, which we will answer afterwards. So none other is better to present, of course, Alternus than the chairman and CEO himself, Mr. Vincent Brown. Please take it away, Vincent.
Well, thank you very much, Harold, and good morning, everybody. Thank you for being with us today. As Harold said, my name is Vincent Brown, Chairman and CEO of Alternus Energy Group. Initially started with the company back in 2015, but actually did a management buyout at the end of 2016 so that I could exploit and really take forward the company for this phenomenal opportunity that we had from that point in time to date. Ever since, we've been growing the company pretty much doubling every year. We started with just 2 parks in Romania and about 6 megawatts, and this year, just now, we're at 130 megawatts operating and 23 plus projects across 4 European countries already. And we're this year alone 5 times larger than we were last year, both in terms of capacity and an annual revenue. So we're very excited to be listing today. It's the first day, as Harold said, on Oslo. Euronext growth market, so it's another major milestone in the journey for the business. So, with that, I thought we might start by giving you a small overview of the company by way of corporate video that we released earlier today, and then I will take you through some of the highlights of the business thereafter.
The world's population is growing, and we demand more energy than ever. As a consequence, CO2 emissions are among our greatest challenges. Every year, more than 50 billion tonnes of greenhouse gases are released into our atmosphere, poisoning our planet.
The world is on a one-time permanent transition from fossil fuel to renewable energy. Solar power is a key component of this transition and is now growing rapidly all over the world. As an independent power producer with a pan-European focus and a dedicated team of industry professionals, Alternus is very well positioned to take part in this green rush over the next few years.
Alternus develops, owns and operates a diverse portfolio of solar PV parks across Europe. Lean and efficient operations drive a strong and predictable cash flow, which enables rapid growth.
Alternus currently owns and operates 65 megawatts, spanning 23 solar PV parks across 4 European countries and producing 81 gigawatt hours of clean energy every year. That's enough to power almost 22,000 average-sized European households. I joined Alternus recently in this very exciting time as we aim to increase the current install base to over 3.5 gigawatts by 2025. This will power almost 1 million homes and help to avoid over 3.5 million tonnes of CO2 emissions on an annual basis.
Working alongside local and international specialist development partners, Alternus benefits from local markets and geographical knowledge, with a constant growing pipeline of new projects for acquisition and construction across Europe.
We've had an exciting journey so far, but we're still at the very beginning. We're looking forward to continuing our expansion by welcoming new team members, new partners, and new investors to take part in what we call our Sunshine Story.
Well, maybe now's a good opportunity that we can take you through some of the investment highlights of the company and why we feel that Alternus Energy at this point is a very good investment opportunity. So I just flowed through the few disclaimers. We're going to cover the investment highlights. There is a full plan. This whole plan is available on our website and also on OSE Markets, should you want more information after our session. What I'd like to do now is just take you through some of the key points of the business, give you a better understanding of how we do things here in Alternus, and then obviously we will open the floor for questions then at the end. So in a high level, we're a vertically integrated solar IPP, which means we can basically operate at all three areas in the solar cycle, from development through to construction and own and operate. Our overall goal is to be the largest, and certainly one of the largest pan-European solar companies by the end of this decade, and we feel we're very well positioned to achieve that. Currently today operate a portfolio, as I said, of 153 megawatts and a 1.4 gigawatts, or about 10 times that size, already contracted for acquisition and construction over the next couple of years here. We do pride ourselves very much on our efficient operations and especially our project sourcing. We actually do quite a lot with relatively few people in the company, and we have been extremely successful over the past few years, in particular in cultivating developer partner networks across all of the countries we operate in, and I'll touch on that a little bit later as to the benefits of that to the company. We're clearly a very equity focused financial profile, so given the recurring revenues, and these projects that we own and operate on average have a 30-year lifespan, and as we move forward, those projects have very stable income over that lifespan. So that allows us to be very flexible and efficient with our debt management as a result of that. And those, of course, determine the equity returns that can be generated from this cash flow. And again, touch on that a little later as we go through here. We obviously, over the past year, have been very successful in growing our development pipeline, our development backlog, and our project acquisition process. And as a result, we believe now we're very well positioned for significant growth. And so much so that we've actually increased our goal by 2025 we had originally thought in December we would get to about 2 gigawatts. And based on our performance just even so far this year, we're confidently increasing that to 3.5 gigawatts by the same time period. So we operate very much in the what we regard as the small and medium-sized utility space of the market. So those who are unfamiliar with solar will tend to read that there's large transactions, large parks, a highly competitive market, and so on. But that is true when you move into that larger utility scale, and certainly has been over the past 10 years, as a lot of the parks benefited from government income schemes, and that attracted pension funds, insurance companies, and so on, who obviously were hunting yield and have a much lower cost of capital. So effectively, they'll pay more for the same asset and the same revenue stream. So we've been focusing very much on one tier below. It is utility scale. So we don't do residential. We don't really do commercial rooftop. We are the larger, as you saw from the video, panels in the ground, and average park size is now about 5 to 10 megawatts, and now we're beginning to grow that as we move forward here. So clearly, this is a very fragmented market. So there's a lot of expansion. The market's growing extremely fast throughout Europe now, given all of the supports that are coming from both corporate and from government to do so. So as a result, there's a lot of new players, a lot of new partners, and that gives us a lot of room to grow within that larger base. Key message just to leave you on this slide is that as we grow, we're aiming to create a portfolio of assets that will over time become scale and large enough to attract attention from these larger players. And as a result, we benefit from what's called yield compression. So we're buying at returns higher, and we can sell them at returns that are lower, resulting in a higher exit price on the assets that we own. So where do we sit today? Again, very briefly, so today we're 130 megawatts operational today. As I mentioned, that's up from just 2 when we started here in 2016. 278 megawatts now that we own, that's in development and construction across the countries. It's very stable income streams. As you see, we're just shy of 20 million euros recurring for the next 8.8, so I'd say 9 years here. And that's the predictability of revenue streams that we have as an underlying business model here in the business. Very small headcount, 25, although it's a relative thing. So we're doing a huge amount, as you can see, with just 25 headcount. We would expect that to grow a little as we expand the company over the next few years here. The diversification that we already have seen is further enhanced by the increase this year alone from to up to 1.4 or 1,400 megawatts of backlog that we have now added into the company in just the first part of the year here. And that's been a significant increase in activity, primarily driven by our successful 110 million bond raise in December, alongside of the 27 million of new equity we brought in at that time. And that's shown the market and the partners that we work with across Europe that we're a very stable and strong now company to execute across the projects that we work on with them. But we're about to be adding Spain and Greece this year, Ireland, so that'll bring our footprint up to about 8 countries. As you can see here, the projects are also at various stages now. So we're currently building ourselves a 14 megawatt park in the Netherlands. It's actually in a very high profile airport there, and that will continue to expand in that 241 megawatts that we now own in the Netherlands. A very difficult and competitive market actually to enter when the parks are operating. So that's a significant value built in to the company, and that came as a result of our recent acquisition of a company called Unison, which we'll touch on here a bit more. So just a quick point, contracted backlog for us means that we have agreed to commercial terms with the developer partners that we're working with. We have exclusivity during that period to perform due diligence, and in most cases here the due diligence will not have yet been concluded, and should it be concluded, then the parks will move into the light blue bar from being contracted into owned. As a result of this, there's an 80% completion expectation if a project is deemed to be in backlog, and again we'll look at that a bit later on. So it doesn't, over a certain period of time, you would find that a project may come and go if it doesn't meet our stringent criteria for purchase. We do work across the projects that we look to acquire with leading both legal and technical advisors in advance of contracting for the project, so we know very much what they look like before we get involved with them. So we will constantly work as we build forward here across the 3 different phases of the project development cycle here. I'm not going to spend a lot of time on this chart. It's really just to give the audience an understanding of where Alternus fits in that value chain, but also the 3 kind of industry phases to owning and operating a park. So we would come in, as you see here, at the mid-development stage and bring the projects all the way through to long-term operations. This would be very similar to what Scatec would do, and I'm sure the audience is quite familiar with Scatec. However, in our case, we also work alongside of local partners who each themselves have all of the local knowledge and work with the local permitting and authorities there to bring the projects forward. And now we're in a position to build our own as well. So we will also work alongside the companies who build and operate on their own, and then we take it, through to operation. So again, target of the company is to own and operate, so stay in that long-term operator 30-year life cycle and build a long-term cash flowing business over the next few years. The reason you get involved in projects at a slightly earlier stage is that ultimately you're paying the developer of the project will take a margin at each phase. So as the projects move from development, where there's a higher risk in terms of project life of it reaching operation, but the amount of capital, as we've seen from the previous slide, is quite low. So only about 5% of the total capital cost will be at this phase, but it's a less certain phase in the project. So as a result, as the projects move forward and they get further up, so they move into ready to build, and then obviously at operation, there's a lesser operational risk, so parties will pay more for those projects, and in effect, the developer takes that margin. So by us now operating at the levels we do and taking coming in at the mid-development stage and at the ready-to-build stage, we're locking in more value into those projects for the company as we bring them forward here over the next couple of years. So as I mentioned, one of the key drivers when moving into that, as we move earlier into the process of owning and operating projects, we had to bring in some additional skill sets into the company. We did that in two ways. One, we hired an excellent Chief Technical Officer in May, Gary Swan. Gary has come from, spent most of his career at a company called Mainstream, which is another Irish international renewables company, and was recently bought by Aker Horizons. Just in the last couple of years alone, Gary has built over 90 megawatts in South Africa from Ireland. So he has a proven ability to manage multiple projects across multiple countries simultaneously, and that was a key hire to the executive team. But on top of that, we had an opportunity to take a majority ownership stake in Unison Energy Europe. We actually knew this company quite well. We bought our Dutch project from them originally back in 2019, and they've been maintaining it for us ever since. So they've also, 10 industry specialists, long pedigree of expertise, and that creates and has given us a very strong engineering capability, both at development, construction, and operational benefits to the business here. So if you look at the benefit of owning and doing EPC ourselves, as opposed to buying everything from someone else, ultimately, on average, the industry has about a 10% margin for the construction phase of the business. By the more and more we do ourselves over the next couple of years, we will then be able to take that margin, keep it in-house, and reinvest it into future projects. Again, in that time frame, that will reduce our need for equity, will allow us to control more elements of the build in-house going forward, and so that we think is a substantial benefit both from the capital, reducing our capital cost and reducing our equity requirement as we're continuing to substantially grow the business going forward. Another key benefit is that Unison bring with them O&M. So operational maintenance is what basically makes the parks operate every day. We have outsourced that to third parties, one of which is BayWa. BayWa is a large German and one of the world's largest renewable energy EPC and operating support firms. We've also bought some projects from BayWa as it happens. And Unison will bring all of that under one house in-house to ensure that all of our projects at all points in time operate to their utmost production capacity. What we do in Alternus then is we manage all of the critical in-house activities such as revenue management and contractual benefits there to ensure maximum return from the projects. One other benefit from having your own O&M capability is that you get to cut on your operating costs. So by way of a quick example, the Dutch park I mentioned that currently operated by Unison, for us, they charge us 120,000 euros a year to maintain that park. It's about 12 megawatts. And now we're going to save 80,000 of that directly and keep that in the business. So that's as we grow out more projects and bring more projects under the management of this part of our business, we deliver significant and continuous savings into the operational aspect and the P&L portion of the business, as well as we've seen earlier, the capital portion of the business. So over the first 10 years of a project, we will then be benefiting from about 37% of project cash flows immediately back to the company, which we will then use to reinvest in future projects that we're acquiring constantly. So one of the key things we mentioned as I came in, the efficient use of assets and our resources. This is one of the key benefits for us, is the multiple. We have cultivated partner networks across the whole of Europe. So we've 20 plus partners today. Some of these partners will be known. So specialist companies such as ReneSola, for example, who are pure international development company. So they take the projects from the beginning up to either construction or pre-construction, and we buy projects from them. Ryzen is a panel manufacturer, so they also create parks to sell them to companies such as ours in the owner-operator space. and so on. But the critical point is as a result of that, we're able to manage multiple projects across multiple countries with very little fixed cost, as a lot of the partner relationships are success-based only compensation. So we're not growing a large footprint. It's why we've been able to operate with fewer people than you would have expected looking at some of our comparable companies. I think Scatec have something like 400 people at the moment. So we feel we're a lot more efficient in how we own and operate and bring projects into the group. Okay, so in terms of that, that's hopefully given you a good sense, of the operations of the company. From a financial perspective, this is really what drives the equity performance of the company, we feel, over time. So today, we have about 90% of our current revenue streams are contracted under either a government feed-in tariff program, green certificates, or indeed investment-grade PPA offtakes. And that's going to be the case up to 2029, just for the current 130 megawatts that's operating. But as we're moving forward, we expect that at any one point in time, all of the new projects that we're acquiring and bringing and developing and bringing up to operation will have about 80% of that revenue contracted. And that allows us a very flexible structure on our debt, as these revenue streams are very stable over the long term. And we take kind of two views as to how you fund these kind of projects. So you can see here that the stability of the revenue stream gives us significant optionality on debt structures, and this increases our equity returns. If you look at it through a typical sample size, here is 100 megawatts. This 100 megawatt sample is a kind of a snapshot of our 1.4 gigawatt portfolio that we mentioned already. So we know these numbers are accurate based on where we are with the projects today. As you can see, they both have the same, so both scenarios will work off an unlevered return of 6.6%. But in the first scenario, we've taken a bond financing approach, or non-amortizing debt, where in the first 10 years we just pay interest only. Now, whereas we sometimes get asked, well, why would you pay a higher coupon on your debt when there's so much lower rates available from local banks or specialist banks on a project finance basis? And we think this is a good example as to why there's a benefit, particularly at this stage of the company's development, to using non-amortizing debt. Straightforward in the first year, you can see, or in the first 10 years in scenario one, even though we're paying a 5.5%, and that's a notional, a target, we would expect to be a little lower than that over time, hopefully, but the markets will determine that in due course. You can see we have more cash flow to the business in the first 10 years, then we put it onto a more standard amortizing debt process over the next 15 years, leaving us with 5 and in most cases 10 years of additional cash flow at the end from the stable cash flows of these businesses. So on scenario 2, it's more where, even though we're paying a lower interest rate, we're actually using more cash in paying down the debt, in effect, very early in the project's life. And those two together, you can see, by scenario 1, we're able to increase the equity returns, or the levered IRRs. This is basically the project equity returns to Alternus, over and above doing it on a lower coupon yet higher cash flow basis. And again, I think this is probably best described in this slide. So if you take it again with the same 100 megawatts on a PPA basis, we take about 6 million project EBITDA for every, on average, for these megawatts. The senior debt servicing in the bond cash and the non-amortizing on the left is 2.2 million, leaving us with about 3.6 million of cash flow to equity. Alternatively, using the amortizing model, yes, the interest is less, but there's more cash used up in the process. And in this case, about 1.6 million incremental cash comes back to the company between the two models, which we then will use to reinvest in future projects. And over that 10-year period, you effectively, all things being smoothed out, and this is an example as by way of illustration, to be fair. But if we take the 1.6 million, it's about 16 million over 10 years. You leverage up with the debt that's very available to the company moving forward, and again, as we mentioned, with the stability of those revenue streams, and that allows us to acquire additional capacity and additional recurring revenues in that period, up to potentially 200 megawatts. So we've turned a 100 megawatt portfolio into a 200 megawatt portfolio over the same period of time, generating about 14 million of additional annual recurring revenues in that period, and at the end of that period, and all without the no need for new equity in that particular case. And that provides a very strong organic growth capability within the company. Now, of course, we'll grow a little faster than that over time as you can see here. But again, wanted to just ensure as to why we feel that debt management is a significant equity benefit, all driven by the fact that we're operating in European countries, not in emerging markets. These are all Western, East and Central European target. We're very much focused on that over the next 5 years. And we will consider other markets during that period, but certainly in the next few years, that's going to be the focus, we believe. So no need to mention, I think everyone's aware of the growth of solar now. One key point just to note, as I mentioned, over the last 10 years, it's been very incentive driven. So the governments, particularly in Europe, have been awarding what are called feed-in tariffs, guaranteed income streams over 20 or 15 or a 20-year period to operators to really build scale in the market and allow it to become competitively capitalized on its own. And that has now been achieved in the 2020 period. As you've seen, the growth experience now is driven much more by commercial demand. It's not subsidy driven. It's in the mass adoption phase of any cycle in the business. And so that's swinging it more towards an operator model where we sit rather than being a purely financial and fund driven type business. So that bodes well for Alternus's positioning here going forward. I think this has been, for me, the key achievement, notwithstanding getting our listing completed and executing on what we had committed to last December. But we've basically doubled our contracted backlog and pipeline in a 5-month period, and that continues to be the case. As I mentioned, I think this is the key driver for me of Alternus's success. It does differentiate us a little from our other peer groups. And 20 plus developer partners are constantly feeding this dark blue line to the right. So 865 megawatts currently in pipeline, and pipeline means that we have a 50% chance of closing the project and moving it into the light blue area here, which is the contracted backlog. Again, a contracted backlog means we've exclusivity agreed, we have the pricing agreed, we're 80% sure we're going to be ending up with the project being owned. But we also expect that to happen within a 6-month period. And that's what determines the light blue segment here from the dark. So with an 80% plus certainty in the light blue and a 50% chance of closing in the dark blue area, we will continue to see our backlog growing, certainly here in the near term. So, and we've been hugely successful, as you've seen, in moving the light blue bars into the green. And the green means we own them. It does not mean they're all operating. What it means is, so if we look at it here, D&C is development and construction, but we own those projects, we own the rights, we own them earlier in the process. So we've locked in that key benefit to the company over the next couple of years as these projects are brought into production by our teams here. So what does that mean? Ultimately, as you can see, the accelerated growth plan now, we have recently announced a increase in our 2025 target from 2 gigawatts to 3.5 gigawatts. But right now, our owned and contracted is already owned and contracted. So up to 2023, we have very high visibility and have a huge confidence level, obviously, in achieving that number. And that number in number terms indicates about 100 to 110 million of annual recurring revenues at the end of 2023, and they're going to continue for our 30-year plus cycle. And then at 2025, if we achieve those numbers, then you're moving it up more towards a 250 million annual recurring revenues on the same basis over the long term. And that will create a company of significant scale with a lot of cash flow that we can either then return through by way of dividends or indeed, as mentioned before, we're also increasing and building out a portfolio of assets that will become quite attractive to other operators. such as, for example, we're seeing private equity now become very attracted by solar in particular. EQT announced recently their potential acquisition of a company called SolarPack in Spain, very similar to Alternus, but they operate in Spain, Chile, I think, and India they've announced, and some other non-European countries. But again, shows that demand building over the next few years for companies such as Alternus. So we feel we have two strong exit opportunities, or at least return of equity over the longer term for investors at this phase of the business. Lastly, then, as we mentioned earlier, one of the key benefits of being an integrated solar producer, or solar developer, should we say, and an IPP over time, is that we get to build some of these projects ourselves. So by the end of this year, we're actually targeting to have about 170 megawatts operational. That will really depend on whether we can bring the 21 here that's currently in construction. We're doing it ourselves, if that can make it by the end of the year, but it will certainly be within the next 12 months. But we're confident we might be able to get that done this year. And then, based on the current contracted backlog and own backlog, we can see visibility that what 2022 will look like and what 2023 will look like. And the larger we build ourselves, in again the light blue bar here, allows us in those cases to benefit from that 10% margin, EPC margin benefit on the capital side, and also then resulting in a less equity requirement. But then also those projects will benefit from the lower operating costs over their lifetime. So again, very visible growth, strong platform, delivering significantly new projects to the company each month here. And I think we've had a very strong first half of the year to prove that out. And we're very much looking forward to delivering on the potential of the company here over the next 20 years, but over the next 24, 36 months to bring us up to 2023 and beyond. I wanted to take the time to thank you for listening. I hope it's given you a good understanding of the company, and we'll open the floor for any questions there may be at this point. And thank you very much.
Thank you, Vincent, for a very clear and transparent presentation. We have a few questions here coming in on the chat. First one is, do you see an increasing willingness to pay for operating solar parks in the market?
So yes, I think the best answer is yes. I think that's where most of the activity still is, and I think that was again mentioned with that EQT deal recently, which is very Norwegian. We're seeing a lot of activity with oil majors across the board. We're seeing a very high interest in operating assets, primarily, if I may, because that's the point of least risk. But that's where you're seeing also the price appreciation for those assets, and that's a good thing for Alternus over the medium term.
Thank you. How about the input factors for building solar parks? We've seen a strong increase in commodity prices internationally. We assume that also affects the cost basis of building solar parks. Do you think that is a long-term effect?
No, that's an excellent question, and indeed that is the case. We are seeing spikes particularly in the panel costs. Labor costs can sometimes offset that, to be fair, depending on which country you're in. But we do see it as temporary. We have good relationships with panel manufacturers, Ryzen included as one. And we now, with the portfolio size we have and the ability to order gigawatts of panels over time here, we get a good view of what they feel the pricing is going to be. So I think the common view is, yes, we've continued to see it through this year. When a market growing at the size it is and the construction levels at the level they are, naturally those prices will drift down again. And we have built that into some of our forecasting as it stands, but we don't see it as a long-term issue.
Good. Another question was, as an Irish company, why did you decide to list on the Oslo Stock Exchange?
I think that's probably a really interesting story, and it's a question we get a lot, and really it was two deciding factors. We were originally listed in the US. So despite the fact that we're Irish, we had a US listing up to the middle of last year, recently in last year. We had been working with your team, Harold, on the bond financing as well. And as a result of that, we met with the bourse last August time, I think. And I was just fascinated with the Oslo bourse, one with its deep history, but also as a renewable hub. And I think, you know, ESG investors in Scandinavia and Norway in particular understand and have a kind of an affiliation for green investments. But I think also, if I may, Scatec did a great job in educating and the world around and the investor community, particularly in Norway, around how this business works. And we've seen their growth over the last 5 years. We do feel that we're pretty similar to where they were 5 years ago. And so we think that's a very good fit in that respect for Alternus. And also the fact that we're operating in Europe exclusively right now is very complementary to the other solar companies currently listed on Oslo. So we just felt that the Oslo market was more appropriate in terms of European listing for Alternus now in effect than the Irish one, interestingly, would have been.
Very good. I mean, you're absolutely right. I mean, there's been a huge amount of listings and attention around renewable companies in the Norwegian Stock Exchange. Especially also one sub-segment has had a lot of attention is around the hydrogen companies. How do you see, how are you prepared for the hydrogen economy? Do you fit into that story as well?
Again, we're looking at that quite intently right now. I think it's still very early. It works in some countries better than others. We do actually believe the Netherlands will be quite strong in that particular area. If you look at it, you know, solar works best. It's now the lowest cost of new energy in the world. So there's going to be a lot more of it. I think when you start layering on hydrogen, then you have to look at distribution. You have to look at how do you know who's the customer for that, where are the customers for that. And I think one of the benefits is you don't need a connection. So if you look at the growth in solar and renewables in general will put pressure on the grids for connectivity. So one of the alternative uses of the parks in that case can be to create hydrogen as one example, and then deliver that outside of a connection requirement. So that's one of the reasons why we're looking at it. However, I really think it's a 5 to 10 year market. So there are some really early adopters. We can see backlogs in order books for the electrolyzers. But without wanting to dwell too long on it, yes, it's an area we feel we will get and will have to be involved in. But I think over the next few years, it's not something that we would necessarily be looking at in the shorter term.
Good. I agree to that. How about you spend a lot of time, of course, explaining your focus on Europe. How long will your focus remain in Europe, and when will you start venturing outside?
Again, look, great question. I think you need to understand your niche. We have a very strong, and I think that's proven in our results, capability here in Europe. I don't think it's going to be too much longer. I think the natural market, if I may, for us would be the US. I think the US now is very strong in renewables. The Biden administration very supportive. Obviously, we've come from a US. I mean, Joe Dewey, our CFO, is actually based in the US. He has a strong US pedigree, and so that's a market we're exploring as a potential next continent, for want of a better term. But I think we do things very cautiously. Even though we're growing very fast, we're actually quite risk averse in Alternus, and we're luckily in a position where we can be. But I think the next natural market I would suggest for us would be the US.
Okay. A follow-up question just came in here. What about the plans to invest in South Asia? Just came in here.
Well, again, look, I think we have not in the short term. Would be the short. I think we have a lot to, as you can see from the results here, we can build a pretty substantial business in Europe alone. And I think, again, we're cautious in expansion plans. We like to understand the markets. Look, ultimately, I'd love this to be a global company. But again, there's plenty of players. It's a massive market. All new entrants are welcome, and I think the larger the industry itself gets, the better for everybody. But I mean, Asia is a completely different, I would say, I was going to say animal altogether, but I think we'd need to understand it a bit better and be a little bit bigger before we'd venture that far south.
Yeah, exactly. I mean, for us following the industry for a while, I mean, we have been used to growth, obviously, and renewables, but still, even for the most optimistic ones, I mean, the market growth has been faster than anyone could have imagined. But still, I mean, looking at your growth just in the last 6 months, I have been amazed again. I mean, people will ask, how did you manage to grow your backlog that fast?
No, look, and again, we're like the 3-year overnight success, if I may. This thing hasn't just arrived. Okay, we've been working on and with these partners that we currently work with for some time. So this is a 2-year plan, coming to fruition. Really, we were capital constrained as opposed to operationally constrained, and that was unlocked with the success we had in December, and that's now proving itself. So we were able to effectively just turn up the dials on the partnerships and take in more projects with our ability to fund them going forward, and that's really the core driver behind it. And driven by that is our partner. We're reporting these increased numbers in backlog from a partner network that has about 10 gigawatts under development themselves, and we're not going to get all of those projects. We do have first look at a lot of them, and that I think is really the strength of our relationship and business model. But it hasn't just been like accidental, or it hasn't been something that we've been able to or just turn on. There are some barriers to entry in the solar market. We're just in a very good position, having invested heavily in that over the past 2 years. And I think that's the clear benefit that you're seeing at the moment. And we also took a decision to move a little earlier into the process with the partners, and that's allowed us to see that visibility over the next few years.
Right. Yeah, you mentioned the success in December, unlocking your potential. That was a combination of an equity raise and a bond raise, and now we had a small equity raise also in connection with this uplisting. What are your kind of near-term plans for further capital raises, equity, non-equity?
Well, look, I think firstly, I would also like to acknowledge, we didn't just take in 27 million and 7. We also brought in some seriously good institutional investor partners as part of that process. So we're really pleased about that. They share the vision for the company and our kind of long-term commitment there. So that also is helping in terms of visibility of funding. In terms of the need, look, these are capital intensive business. So, you're always building new projects or acquiring existing operating or in construction projects. So we need capital. As I mentioned throughout the presentation here, however, given the strong cash flow benefits and the fact that we're locking in a lot of value sooner in the process, we believe we can do a lot of what we want to achieve here with debt initially, and maximize and optimize debt structures to minimize, obviously, the equity requirement. Plus, the bigger we get, the reinvestment of those cash flows mean a slightly lesser equity. But having said that, we do expect that we will have to come back to the market as and when required. We only ever do that when we're growing. So, we're cash flow positive. I think we're income positive. We're certainly EBITDA positive. I think we're income positive. So, on a day-to-day basis, the company only ever needs equity to grow and increase the business footprint. So, at all points in time, I think we'll have a very welcome market for such investment. Timing of it, Harold, to be fair, is a little. We will always leave equity to the last portion of the funding requirement, as you would expect, to maximize the benefit for equity. So, it really will depend on how fast we can execute on the plan here, and if we want to accelerate that or not. Obviously, we will try to do that. So if the markets are there and we feel the valuation is good, then we would take in equity at that point. But we do manage that. Certainly, the equity raising side of the business very carefully.
Great. Well, it seems like we've been through all the questions that have been incoming. If you allow me one final question from myself here, particularly interest, obviously, when are you going to enter the sunny Scandinavian markets?
Oh, I got that question yesterday actually as well. I mean, it's an interesting one for us. We're constantly looking. I think at the moment we're looking at a balanced portfolio, and obviously Scandinavian countries for solar have not been historically, more natural. It's more like Ireland. A bit wind is probably a little bit more structured there. But we see solar now being able to compete everywhere, and I think that's really the change you're going to see here over the next couple of years. So in short answer, look, it would be very good to have a presence in Scandinavia. We do have some opportunities that are early that we are looking at. At any point in time, if I may, we're looking at it like a 2/3 Southern European and 1/3 Northern European kind of blend in the projects. Because if you consider the same panel will produce, 1.5 to 2 times the energy in the southern countries than it will obviously in the northern countries, but it's the same investment cost. So at the same time, the southern European countries can be seen as, less, shall we say, attractive from a credit perspective than the northern ones. So that's why we have a constant blend, and we feel that creates that pan-European portfolio, gives both credit enhancement and performance in one single entity. And I think that's where we'll continue to focus the efforts. So short answer, we're trying. We will see what we can come up with in Scandinavia over the next couple of years.
Brilliant. Well, I mean, it seems like the listeners have had all their questions answered and more. So I think then we'll say thank you for this time, and I'm sure we'll see each other again. And I just want to remind also the listeners that Alternus has a very good website where you can contact the company directly and ask questions, which you will have answered quite quickly, I'm sure. But we leave it for now, and thank you, Vincent. It was a great event.
Thank you, Harold, and thank you everybody for listening to us today. Have a good day.